Hey, what's up guys? So today I'm going to do a deep dive into the popular smart money concept. So this is where I show you how the big boys move the market and how we, the smaller boys, can actually leverage their strategies for ourselves. So throughout this video, you will be learning new terms, right? If you are new to this concept. But don't worry, right? I'm going to explain these terms as I go along. So I promise you that once you finish this video, you will have a good grasp on the smart money concept and know how to apply it effectively. Right, so first off, the first step in analyzing a price chart is to identify the trend, to determine whether the buyers or the sellers are in control. So the goal is to always trade in alignment with the controlling side of the market. So how does the system work? The system functions based on this term, mitigations. When the price mitigates a demand level, demand takes control over supply. So now, on the other hand, when price mitigates a supply zone, supply takes control over demand. Imagine the price is in an uptrend, forming what? A series of higher highs and higher lows. So each time price breaks the structure to the upside with inefficiency, a new demand zone is created. So these demand zones remain unmitigated until price revisits them. So now, until the price taps into these demand zones, it presents perfect opportunity to follow the dominant trend. However, if the price breaks below the valid demand zone, this signals a change of character. So this indicates two things. First, the supply, the sellers, right? The supply has taken control over the demand. Sellers has taken control over the buyer, right? So supply has taken control over the demand. Number two, a valid supply area now has been established. So now you got the supply zones. So the price then continues to move downwards, forming additional supply areas until it reaches the next unmitigated demand zone where price has not touched before yet. So now, there is a constant battle between supply and demand at all times. At all markets, it's always a battle between the buyers and sellers, the supply and the demand. It's always like that. So that's where you understand the bigger, broader perspective, right, of the big boys. Now, at times, this results in what? Consolidation and a ranging market between the two zones. So breaking either zones would reveal which side has gained control, whether is it the buyers or the sellers. Now, we see 1, 2, and 3 moves that breaks above the previous market structure. So this indicates what? That demand is in control, right? The buyers are in control. We also have an unmitigated demand area here, so which now acts as a support when price returns to this level. So now, once again, we see a temporary correction and the price breaks the high with an imbalance, forming another strong demand area. So the market sentiment remains bullish as long as the price continues to trade above the extreme demand zone. Now, we can observe that the market has tested the demand level but failed to create a new high due to what? Lack of buyers in the market, lack of buyer strength. After breaking below the low point, it indicates what? The buyers are no longer in control and a reversal may occur. So now it's no longer going up, potentially going downwards. So if we consider this point as the beginning of the impulsive move that caused the market structure shift from uptrend to downtrend, from the higher highs, higher lows, now you break the lows, right? This signals a potential change in direction. Here lies our supply area, and the market continues to break structures to the downside. So indicating that the supply is in control now, creating multiple supply zones. All right, so now each supply area presents potential selling opportunity. All these areas are selling opportunity until the price reaches what? An unmitigated demand area. So this zone could attract buyer interest because price has not touched that before, right? So leading to a potential battle between what? The buyers and the sellers. So now at this point, what we do? We wait and observe further price action to determine the market direction. As this level could be the turning point or lead to temporary correction. So this is a very crucial level. So now, it is essential to remember that while we cannot control the market, we can prepare for different scenarios that may unfold. So as traders, as pro traders, we are always planning the different situations that may unfold. It's not like we are fixated on one outcome only. No, it doesn't work like that. So now, let's move on to the next topic. So I'm going to show you some basic concepts about the smart money market structure. In an ideal trend, the market consistently forms what? Higher highs, higher lows. Each time the market breaks structure to the upside with an imbalance, a new demand level is created. So the imbalance between the buyers and the sellers is what? Is identified through this term, where you observe fair value gaps in price action. These demand levels that form fair value gaps are crucial for your chart analysis. This fair value gap, right? They are the core of the smart money concept. As long as the price remains above this zone, the demand is in control. Then the market sentiment would remain bullish. However, if the price breaks and closes below this level, this signals a change of character, indicating what? A potential reversal. So the levels that create fair value gaps and the break of structure are key structure levels. They are the key market structure levels. Responding to these levels, they will give you really good insights, right? So this concept would apply to same thing, a bearish scenario. Remember, the market structure and liquidity zones, they are inseparable. That means you don't separate them. Market structure and liquidity zones, they are pretty much the same. You got to link them together in smart money concepts. Many liquidity area gain significance through market structure. Many market structure lose relevance without considering liquidity concepts. Okay, so this is a little bit advanced. So now, liquidity areas are where the retail traders engage in the market. Multiple rejection at certain levels make these spots fueling as potential entry points for the traders. As a result, many stop losses and liquidity are accumulated at these levels, creating the zones of interest for smart money traders. So, smart money concepts aims to sweep retail traders' stop losses, creating liquidity. This is how the big boys function. So the goal is to enter the trade after these stop losses have been swept, positioning yourself alongside with the smart money for a higher probability setup. Now, let us show you some of the most powerful models that combine the market structure and liquidity on the chart. The first model involves a basic liquidity sweep through a major market structure level. So for example, take a look at this chart. We see a clear uptrend where the market has rejected a recent support level multiple times. As price approaches this level, so price action traders would what? They typically go long, right? Expecting what? Another rejection from this key zone. So meanwhile, traders who entered long positions earlier would look to support their position. So this area now is considered a key liquidity level. And stop losses are gathered somewhere below this area. So most traders will put their stop losses there, right? So now the question is, where can be a point of interest as a smart money trader? If we examine the left-hand side of the chart, right, we can identify fair value gap within an extreme demand zone. So this becomes our point of interest, offering potential buying opportunities over there. So now, as smart money traders, the goal is to enter the market after the stop losses have been swept. So using precise combination of market structure and liquidity concepts, that's where you can make all these informed trades. So now, let's check the second liquidity model. So we have a valid order block and potential trading opportunity to go long in this case. However, if you look at the left, right, you will notice a gap between the candles located just below the first order block and another valid order block nearby. So this setup creates additional opportunities for identifying entry points based on liquidity and order blocks. So now, this gap, right, the gap here, act as a magnet. So they attract price to fill it, restore the balance, and then potentially continue to push it upwards once it mitigates the second order block. Okay, so now, here are the two key points. Number one, before placing any trades, always examine the left-hand side of the chart to avoid unnecessary risk. Number two, this helps identify potential gaps or liquidity zones that could impact your trading decision. Alright, so first, before placing any trade, you should always check the left-hand side of the chart to spot potential risks. So such as what? Gaps or liquidity zones, so that you will avoid unnecessary exposure. Right, so now, second, when a gap and another valid order block forms just below the first one, this break is not considered a valid change of character yet, as it could simply be a liquidity grab rather than an indication of an actual reversal. So now, we covered fundamentals of chart analysis, including identifying market direction, the key levels, and trading opportunities. So now you're better equipped to apply these smart money concepts. Let me explain 3 of the best smart money concept trading setups, step by steps, or with the rules that we talk about. Order blocks are optimized in supply and demand areas, right? So they form whenever we have sharp moves with imbalance, breaking the previous market structure. Typically, we mark the last candle that created the fair value gap as an order block, as this is where the key decision are believed to have been made. So the order block trading setup is straightforward and effective. So in this setup, we use a basic order block entry when aligned with specific market conditions. So the first step to identify a valid and fresh order block recently that is created by market, right? A valid order block must show clear inefficiency and fair value gaps between the wicks, breaking the market structure. So next, we place a buy order, which is like just a spread size above the order block, and set our stop loss below the swing low. So once the price reaches 2 times our risk, that's where we can close half of the position. So this ensures that even if the price hits the stop loss, that's fine. We are at break even. For now, for our second target, we can aim for the next key level before the price. Trade with the market direction. So this strategy is most effective as a trend continuation setup. Always trade when the market direction is clear, right? And the controlling side, the buyers or sellers, are identified. So now, trading with a dominant trend increases your chances of success, and they reduce the risk of getting trapped in the wrong market side. So now, check the higher time frame key levels before trading. This is essential to assess how much room price have before reaching these levels. So a small reaction at a higher time frame key level can signal major direction change in the lower time frame. Right? So this is a combination of what? Multiple time frames. So when the price mitigates a higher time frame key level, there is a higher chance of a temporary reversal. So that's where you always verify the higher time frames to understand the distance between the key levels and then adjust your strategy accordingly. So now, next, analyze the left-hand side of the structure before placing any trades to avoid low quality setups. So for example, if the order block is positioned within a liquidity zone, or there are gaps and another order block is just below, the risk of a liquidity grab increases. So this can lead to what? Premature stop out. So therefore, it's important to evaluate this risk before entering the trade. Next, imagine we are in an uptrend and the latest move breaks the market structure to the upside without creating inefficiency. So now, on the left side, we observe inefficiency just below the swing low, along with a valid order block zone. So in this scenario, it's more likely that the price will continue and will break below the swing low, grab the liquidity, and then continue pushing upward once it taps into the order block demand area. So now, when this pattern forms, we place our buy order, a spread size above the order block, and set our target at the next level ahead of the price. So the stop loss is placed where? Below the swing low, with an entry based on combining the order blocks and the liquidity sweep below a minor demand area. So that's where you get a higher probability trade setup. So the same concept is applied to a bearish scenario as well. Now, that's where we use 2 time frames to execute our trades based on this setup. In the first step, we analyze the market direction and structure and then mark our higher time frame order block zone. Now, then we wait for price to return to the order block. That's where you zoom lower to the lower time frame to look for a change of character formation to confirm our entry. Okay? So if there is no change of character that forms, you don't take a trade. So a change of character signals that the short-term trend may be over and the market could finally start moving upwards. So these are the 2 common scenarios for entering trades based on this setup. Number 1, change of character with inefficiency and an order block. Number 2, change of character without inefficiency using the Fibonacci retracement levels. So now, when the change of character occurs alongside inefficiency in price movement, and then it forms another order block, this creates a high probability setup. So you can place a buy limit order just above this new order block, and then you position your stop loss below the recent swing low. So this setup will allow you to capitalize on the market potential reversal with the inefficiency, right? Indicating a gap in the buying or selling pressure. Now next, change of character without inefficiency or order block. Alright. So when a change of character occurs without creating an inefficiency or an order block, we use Fibonacci retracement levels to enter the market. So to do this, you apply the retracement tool from the beginning to the end of the change of character move, and then you place your buy position between the 61.8% level and the 78.6% retracement level. So this strategy can be applied across various time frames, but your entry time frame should be at least 2 times lower than your higher time frame for optimal accuracy. All right, so now let's do a quick recap of what you have learned today. Number 1, smart money concepts offers traders a clear framework for analyzing price action, helping them to execute high RR, right, risk to reward ratio with confidence, right? So now, by focusing on market structure, supply and demand zones, and liquidity, right? So that's where you can anticipate market movements and then you avoid unnecessary risk. So then next, combining Bollinger Bands, RSI divergence with smart money concepts, right, can provide high probability trade setups for trend continuation or reversals. So this can be an add-on. Okay, next. Understanding how to identify key levels and applying order block strategies. This will allow you to optimize your entry and your exit points. Alright, so next. When you analyze the market direction and higher time frame key levels, so this is where you can align yourself with the dominant trend. Right? Remember, always look left, right? Increasing the likelihood of profitable trades. So thank you so much for watching. If you enjoyed this video, please give it a thumbs up, right? It really helps to keep the channel growing. And if you are new here, don't forget to hit that subscribe button and turn on the notification bell so that you never miss an upload. So we also love to hear from you, right? Drop a comment below and let us know what you think or what you'd like to see next. I mean, your support truly means the world to us. It keeps us motivated to bring you awesome content every week. And if you're keen to learn more, I've created a free 5-part comprehensive training where I show you exactly how I trade using my lifestyle method. Link in the description below.